NYC, I'm Kara Stevens, Work with NYC's resident money coach. Welcome back to the Money Lab, where we break down money topics so you can feel confident and in control. Now, today we're diving into the basics of investing, what it is, why it matters, and how you as city employees are in one of the best positions to start. Now, before we jump in, don't forget to like this video, subscribe, and hit the notification bell so you never miss a tip on growing your financial well-being. Now, another quick reminder, I am not giving you financial advice or endorsing any financial products. I'm here to help you understand your options so you can make smart decisions. So, what is investing? Investing is just putting your money to work so it grows over time. Think of it like planting a seed. If you water it and give it sunlight, it multiplies into more. One of the most important ideas is diversification. That means spreading your money across different types of investments or asset classes so you don't have all your eggs in one basket. Investing can feel intimidating, but let's break it down using something we all understand and love: food. Imagine investing like eating at different types of restaurants or buffets. And we'll get started with stocks. Buying a stock is like ordering one dish. If the restaurant becomes popular, your dish becomes more valuable. For example, if you bought stocks years ago from a popular tech company, as their products took off, your plate just kept getting tastier and more valuable. Let's move on to bonds. Bonds are like paying for a meal plan in advance. You give the cafeteria money today and they promise to feed you later at a set price. For example, when you buy a U.S. Treasury bond, you lend the government money now and they guarantee to pay you back with interest, like more meals than you paid for. Then there are mutual funds. A mutual fund is like hiring a chef to build your plate. You trust them to choose the right mix of foods, some veggies here, some protein over there, and some grains. For example, when you buy a mutual fund, a professional manager decides which stocks go on your plate. Mutual funds are actively managed by financial professionals and for this reason cost more. Now let's move on to index funds. Index funds are like saying, I'll just take a little bit of everything at the buffet. You don't get picky and you don't pay a chef to decide. For example, an index fund that mirrors the S&P 500, which is a stock market index, or kind of like a list, that tracks the performance of 500 of the largest publicly traded U.S. companies, would give you a taste of these 500 companies, one by each. Then there are ETFs. Exchange traded funds, or ETFs, are like pre-packed snack boxes. You can grab them quickly, trade them easily, and still get a variety. You can purchase an ETF that gives you a little bit of almost every U.S. company in one neat package, or an ETF that gives exposure to companies outside the US, like in Europe, Asia, and other emerging markets, or industry-focused ETFs that are neat packages of tech or healthcare companies, for example. Now that we talked about what investing is, let's step back and discuss where and how investing actually happens. Let's break it down in a simple way. First, we have exchanges. Think of exchanges like marketplaces where the stocks are bought and sold. In the US, the main exchanges are the New York Stock Exchange, or the NYSE, and the National Association of Securities Dealers Automated Quotations, or the NASDAQ. The NYSE is home to many large established companies, while the NASDAQ is mostly tech and growth companies. If you want to buy a stock, you're buying it on one of these exchanges. Next, we have indexes. Indexes track groups of stocks to give us a snapshot of how the market or part of the market is doing. The S&P 500, as we said, tracks 500 large US companies and is weighted by market capitalization. Market capitalization, or market cap, is the total value of a company's stock. You get it by multiplying the total price by the number of shares the company has. For example, if a company has 1 million shares and each share is $50, the market cap is 50 million. In the index, like the S&P 500, bigger companies with larger market caps have more influence on the index. So if a big company does really well, it moves the S&P 500 more than a smaller company's stock would. On the other hand, some indexes are price-weighted, like the Dow Jones Industrial Average, which tracks 30 big, well-known companies. That means the higher-priced stocks have more influence on the index than the lower-priced ones, no matter the size of the company. For example, if a 300 stock goes up $10, it affects the Dow Jones more than a $50 stock going up by $10. The Russell 2000 tracks 2,000 smaller companies, giving a snapshot of small cap performance. A small cap company is a small size company based on the total value of its shares. Small cap companies usually have a market cap between 300 million and 2 billion. They're often younger and less established than larger companies, so they can be riskier but have higher growth potential. The Russell 2000 itself is market cap weighted, which means the bigger small cap companies have more influence on the index's overall performance. You don't invest in an index directly. Instead, you invest in the funds that track the index, like the mutual funds or ETFs. This gives you exposure to the whole group of companies without picking individual stocks yourself. And of course, behind every stock are real companies. When you buy a stock or invest in a fund, you're owning a piece of these businesses, which are all traded on the exchanges we talked about. In your deferred compensation plan, the funds you can invest in are made up of these companies and other assets from the market. A stock fund invests in shares of companies listed on the NYSE or NASDAQ. A bond fund invests in U.S. government or corporate bonds. A target date fund automatically mixes these investments based on your expected retirement year. So when you invest in your plan, you're indirectly investing in the performance of real companies in the market without having to pick each stock yourself. Now, here's something many city employees don't always realize. When money is deducted from your paycheck and goes into your retirement account, your agency is investing that money for you. By enrolling in a city pension plan, which the city contributes to, and the New York City Deferred Compensation Plan, you're already an investor. The New York City Deferred Compensation Plan has tax advantages, low fees, and allows investing in index funds and mutual funds. You can increase or decrease the amount you contribute to the plan at any time. And if you haven't started the process, visit each plan's website to learn more. Before you start, it's important to know two things. One is your risk tolerance. Think of risk tolerance as your emotional stomach for investing. If the stock market drops and your portfolio takes a hit, do you shrug and think, that's normal, I'll bounce back? That's a high risk tolerance. If the same drop keeps you up at night worrying about whether you should sell everything, that's low risk tolerance. Neither is wrong. It just means you have to align your investments with what you can handle emotionally so you don't panic sell at the worst possible time. Now, risk capacity is different. It's your real life ability to take on risk. A 25-year-old who has decades before needing their retirement money has high capacity. They can afford to wait out market swings. But someone who's 60 and planning to retire in 5 years does not have the same flexibility. Their capacity is lower because they'll need that money sooner. Same goes for your financial safety net. If you're paying off high interest debt or don't have an emergency fund, your risk capacity is lower because you can't afford major losses right now. So this is how they work together. The sweet spot is knowing both. So let's talk about if you have high tolerance and low capacity. This is when your emotions say, I can handle risk. But your situation says, not so fast, my friend. Imagine you're 55, close to retirement. You might love the thrill of aggressive investing and feel unfazed by market drops. But because you need your retirement money soon, you don't actually have the time to recover from big losses. In this case, your confidence could trick you into taking risks that your real life circumstances cannot support. That's why you need to pull back and invest more conservatively, even if you feel bold. Now, let's talk about high capacity and low tolerance. This is where your situation gives you plenty of room for risk, but your emotions can't handle it. For example, if you're 25 and decades before retirement, you could aggressively invest and have time to ride out ups and downs in the market. But if every dip in the market makes you anxious and ready to cash out, you'll end up sabotaging yourself. Even though you technically can afford more risk, you shouldn't invest in ways that make you miserable. You're better off with a balanced mix that keeps you steady and consistent. The bottom line here is investing only works if you stick with it long term. So the goal is to balance what you can handle emotionally with what you can afford financially. Investing should help you build wealth and let you sleep at night. Once you have a handle on your relationship with risk, we can move to action. Let's use the New York City Deferred Compensation Plan as an example. Step 1 is open a New York City Deferred Compensation Plan account. Think of this as opening a bank account, but for investing. Step 2 is decide what you want to invest in. Based on your capacity and tolerance for risk, choose what you want to invest in. If you want something more balanced, look for options in your New York City Deferred Compensation Plan that integrate index funds or mutual funds because they spread your money across many companies. Now that you're an investor, this is how you stay an investor. The third and final step is to track your performance, but not too frequently. You can log into your New York City Deferred Compensation Plan account to see how your investments are doing. But here's the catch. Don't check too often. The market goes up and down daily, sometimes hourly. If you check every day, you risk panicking on the bad days and getting overconfident on the good ones. That emotional roller coaster can lead to bad decisions. A better approach is to check in a few times a year or when you're reviewing your goals. How well your investments are doing is really subjective. It depends on your goals, timeline, and risk comfort. But here are some common indicators to help you evaluate your progress in your deferred compensation plan. The first way is looking at the portfolio growth over time. Look at the total value of the deferred compensation account. Is it increasing over months or years? Even if it goes up and down, steady growth shows your money is working for you. The second is to look at the rate of return. This tells you the percentage your investments earned over a specific period. Now let's go into a few examples. Example number 1. If the stock market, like the S&P 500, grew 8% last year and your portfolio grew 10%, you, my friend, outperformed the market. On the other side, if the market grew 8%, but your portfolio only grew 5%, you underperformed the market. That does not necessarily mean your investments are bad. It's just a signal to check if your asset mix or fees are affecting the performance. And the third is to look at the achievement of your financial goals. Ask yourself if your deferred compensation investments are helping you reach your personal goals like having enough for retirement or planning for life after work. Performance isn't just numbers. It's making meaningful progress toward what matters to you. And a final indicator, though not exhaustive in terms of this list, is the preservation of the principal. Check whether your original contributions are being protected. Even if returns are modest, keeping your starting amount safe is important, especially if you're closer to retirement or need to rely on those funds sooner rather than later. And one of the most important parts of the retirement planning process is consistency. Instead of trying to time the market, which is guessing the perfect time to buy or sell, many investors set up automatic deposits every month, like $50 or $100, into their chosen fund or stock. This is called dollar cost averaging, investing the same amount at regular intervals like monthly. It smooths out market ups and downs and builds consistency. Thankfully, as a city employee enrolled in the New York City Deferred Compensation Plan, automatic deductions come from your paycheck and into your plan every single month, year in and year out. It's also important to think about the long term. Investing is not about timing the market day to day. It's about staying in the game for decades. The ups and downs even out over time. You also want to think about diversifying and rebalancing. Do not put all your eggs in one basket. Spread your money across investments, then check in periodically If one area grows faster and throws off your mix, rebalance it back to the original plan. A common question I get is, Kara, should I invest if I still have debt? The answer is it depends on the type of debt and your interest rate. So first, high interest debt, which are debts that have interest rates higher than 5 to 7%. These usually include credit cards, payday loans, or personal loans. These debts grow faster than most investments can, so your priority should be to pay them off first. If your credit card charges 20% interest, paying that off is like earning a guaranteed 20% return, something the market simply cannot match consistently. Then there are low interest debt with interest rates with less than 5%. This includes things like federal student loans or a low fixed rate mortgage. Since the historical average of stock market returns after inflation have been about 7% or more, it often makes sense to invest while making minimum payments on those types of debt. Essentially, your money can grow faster in the market than the interest you're paying on the loan. And then there's the middle ground, where the interest rate kind of hovers between 5 to 7%. This is a gray zone. Here you want to consider your personal risk tolerance, the comfort with the ups and downs, and risk capacity, your actual ability to take risks based on your life situation. For some, it makes sense to pay it off aggressively. For others, a split approach. Some extra towards debt, some toward investing works best. Now that we've covered and cleared this up about how to invest while having debt, let's pivot and start talking about some of the big mistakes people make when investing that I want you to avoid. Mistake number one is, I can only invest in stocks. No. Do you remember our food analogies of buffets? Well, this is where you want to remember that. You want to diversify. You don't want to only have one thing on your plate. Mistake number two, I have plenty of time, so I can wait to start investing. That, my friend, is dangerous thinking. The earlier you start, the more time your money has to grow. Time is the biggest multiplier in wealth building. Mistake number three, I have to put in a lot of money to invest. Not true. Start with as little as $25 or $50 a month. Consistency matters more than size. Mistake number four, it's too late. I am too old to start. Let me tell you something, friend. That is false. You may not invest as aggressively, but it's never too late to grow your money. Mistake number five, timing the market. Even the pros get it wrong. Focus on time in the market, not timing the market. Mistake number six, chasing hot tips. Don't invest based on your cousins, co-workers, best friends, former college roommates' guaranteed stock picks. Stick with the proven strategies. And the final mistake, mistake number seven, is expecting guaranteed returns. If someone promises you returns way above market averages, run. It may be a scam. Before we wrap up, here are 3 timeless rules of thumb to keep in your back pocket. Now, they are not strict laws, but they're simple shortcuts that can help you make more sense of this new world of investing. The first rule is the rule of 72. Want to know how long it will take you to double your money? Well, you divide 72 by the annual return rate. An example of this is at an 8% growth, 72 divided by 8 equals 9 years. The second rule is the 4% rule, which is a retirement guideline. You can safely withdraw about 4% of your portfolio each year and expect your money to last around 30 years. According to the 4% rule, you can withdraw $40,000 a year. That's 4% of $1 million to live on. The idea is that with a balanced portfolio, your investments are likely to grow enough to replace what you're taking out, so your money can last about 30 years. If you had $500,000, that would mean about $20,000 a year. If you had $2 million, that would be $80,000 a year. Now, the third and final rule for our time together today is the rule of 110, or sometimes 120. This is a quick way to think about how much of your retirement savings should be in stocks versus bonds. Here's how it works. You take the number 110, subtract your age, and that number is the percentage of your portfolio you might hold in stocks. The rest will go to bonds. For example, if you're 40, 110 minus 40 equals 70. That means 70% in stocks and 30% in bonds. The idea is that when you're younger, you can take on more risk in stocks to grow your money, and as you get older, you gradually shift into safer investments like bonds. If you were 60, 110 minus 60 equals 50. So about 50% of your portfolio would be in stocks and half in bonds. Now here's where your deferred compensation plan makes this really easy for you. Instead of doing the math and moving money around by yourself, most plans have something called a target date fund, often named for the year you plan to retire, like the 2045 fund. Inside these funds, the same principle is at work. When you're younger, the fund is mostly in stocks. As you get closer to retirement, the fund automatically shifts into more bonds and cash-like investments to reduce the risk. This gradual shift is called the glide path. So the rule of 110 is great for understanding the concept. It's the DIY version, but your target date fund applies that logic automatically for you. You don't have to rebalance every few years. It's done for you. The takeaway here is simple. Whether you do it yourself or use the target date fund, the goal is the same. Grow your money when you can take on more risk and protect it as you get closer to retirement. The target date fund just makes it easy and hands-off. Now, as your money coach, your favorite money coach, I'm going to leave you with some homework. First, view WorkWell NYC's on-demand videos to learn more about other financial wellness topics. Second is make an appointment at any NYC Financial Empowerment Center for free, confidential, personalized guidance to support you in reaching your financial goals. Third, enroll in a city pension plan or contact the plan directly with your questions and inquiries. Fourth is enroll in the New York City Deferred Compensation Plan. And finally, access the city's free student loan support resource called Summer, a student loan management tool and resource available to all city employees. Now here's the bottom line, NYC. Investing doesn't have to be complicated and it doesn't have to be scary. You start small, stay consistent, know your risk tolerance and capacity, and avoid the common traps. The earlier you begin, the more powerful time and compounding become. Your future self will thank you. And of course, don't forget to subscribe to WorkWell NYC for more tips and strategies. I'm Kara Stevens, your resident money coach, and I'll see you in the next video.